So first, what is stock? In finance, stock consists of all shares into which ownership of a corporation or a company is divided. A single shares of stock means fractional ownership to the corporation in proportion to the total number of shares. What is the value of stock? A stock value is what someone is willing to pay for it. Basic factors affect stock prices over the long term, but the law of supply and demand rules stock prices in the short term.
Types of a common stock. Although most firms have only one type of a common stock, in some instances, classified stock is used to meet a special need. Generally, when special classifications are used, one type is designated to Class A, another to Class B, and so forth. Small new companies seeking funds from outside sources frequently use different types of a common stock. For example, when Google went to public, it sold Class A stock to the public, while its Class B stock was retained by the company's insider. The key difference is that Class B stock has 10 votes per share, while Class A stock has 1 vote per share. For this reason, Class B stock is this type sometimes called founder's shares, because dual class share structure of this type gives special voting privilege to the key insider. Note that Class A and Class B and so forth have no standard meaning. Most have no classified shares.
Stock price versus intrinsic value. First, we must define what is stock price or share price. Is the amount it would cost to buy one share in a company. The price of a share is not fixed but fluctuates according to market conditions. It will likely increase if the company is perceived to be doing well or fall if the company is not meeting expectations. Let's move on to the intrinsic value. Intrinsic value is a measure of what an asset is worth. In financial analysis, this term is used in conjunction with the work of identifying as nearly as possible the underlying value of a company and its cash flow.
There are different approaches for estimating the intrinsic value of a common stock, one of which is a discount dividend model. If you own a share of stock, you can receive cash in two ways. First, the dividends the investor receives each year, and second, the price received when the stock is sold. As we value the share or price to share, the price is simply the present value of this cash flow, and this leads us to our first equation. The price at time 0 or the P sub 0 or the current price is equal to the summation of each dividend payment from time period 1 to infinity. And this equation also simply tells us that the stock value is the present value of dividend. But the question is, how can we estimate an infinite number of dividend payment? There are actually three approaches or assumptions, one of which is the zero growth. A firm will pay a constant dividend forever, or whatever the dividend amount is, it's going to stay on that amount forever. Here, the price is computed using the perpetuity formula, or the P sub 0 is equal to dividends divided by your required rate of return. For example, the current stock price of ABC Company is 25 pesos and 68 cents. If the required rate of return is 14%, what is the dividend paid by this firm which is not expected to grow in the near future? Take note that it's stated here that the dividend is not expected to grow in the near future, and that's zero growth. Here, the P sub 0, the current price is 25 pesos and 68 cents. Your required rate of return is 14%, and we need to solve for the dividend. Using the formula, substitute all the values and you will get your dividend is equal to 3 pesos and 60 cents. The next assumption is the constant dividend growth. Here, the firm will increase the dividend by a constant percent every period. Before we solve the constant dividend growth problem, we need first to compute the value of any dividend payment for any time period. Using this formula, we can find any dividend or the D sub T by simply taking the dividend we know, or the D sub 0, multiplying it by 1 plus a growth rate raised in the number of compounding periods that we need to compound. Remember that D sub 0 zero is your dividend just paid. And the constant growth model, or also known as the Gordon growth model, is that your current price, or the P sub 0, is equal to the next year's dividend, or your D1, divided by the rate of return minus the growth rate. For example, Snowdrop Company had been growing at a rate of 6% for the past 2 years, and the company's CEO expects the company to continue to grow at this rate for the future year. The company paid dividend of 2 pesos and 50 cents last year. If your required rate of return was 13%, what is the maximum price that you would be willing to pay for the company's stock? Note that we need to solve first for the D1, and your D sub 0 is 2 pesos and 50 cents. Your growth rate is 60%. Substitute all the values and you will get your D1, which is equals to 2 pesos and 65 cents. Now we need to solve for the maximum price. Your required rate of return was 13%, your D1 is 2.65, and your growth rate is 6%. Using the Gordon growth model, substitute all the values and you will get your maximum price, which is equal to 37 pesos and 86 cents.
A common point of confusion for novice and beginning investor is sorting out the differences between dividend versus growth investment and determining which to choose. With dividend investment, the excess return is declared and shared with investor while the profit excess is withdrawn as dividends. In growth model investing, the excess return is reinvested in the corporation, and the only way profits are materialized is when the stock is redeemed or the stock is sold. Each type of investment has advantages and disadvantages, which depends on the investor's individual goals, financial circumstances, and investment horizon. Dividend investing involves buying stock that pays dividends. The company pays its shareholders a distribution of proportion of profits. This offers investors a chance to benefit from a stream of income in addition to the growth in the market value of the stocks. In growth stocks, money remains invested in the company is not paid out in periodic intervals. Instead, all excess return generated gets reinvested back into the stock itself. In other words, with growth investing, profits are only materialized when the stock is sold or redeemed. So when you are investing in growth stocks, you are banking on future projections and the possibility of companies growth and resulting asset value growth.
Two conditions that are necessary for constant growth or Gordon model to be used. First, the required rate of return must be greater than long-run growth rate. If the long-run growth rate is greater than required rate of return, the answer would be negative, which is wrong as stocks can't have negative nor infinitely high price. Second, constant growth model is not appropriate unless a company's growth rate is expected to remain constant. Constant growth model is sufficiently general to handle the case of zero growth stock. Most firms live in rapidly growing startups and others that pay no dividend at present and can be expected to pay dividend at some point in the future, at which time constant growth model will be appropriate. Valuing non-constant growth stock. Let's take a look on this example. In finding the value of a non-constant growth stock, first we have to compute for the dividend. This is the calculation. Note that we only use D0 to calculate the dividend in time 1. In solving the dividend in the following times, the process is the same but we have to use the dividend in the previous time. Second, we will going to solve the expected price at the beginning of the constant growth period. In this problem, it starts in time 3. This is the calculation. 2.7287 divided by 0.134 minus 0.08 is equal to 50.5310. The stockholder could sell the stock for this price at time 3. Lastly, we will discount the dividend at the required rate of return. In the sum is the value of non-constant growth stock. 39.2134 is the net present value.
Now let's talk about corporate valuation model, also called as free cash flow valuation. It believes that the intrinsic value of a company equals its present value of free cash flow. How to apply corporate valuation model? First is to find the market value of the firm. That would be free cash flow of the firm times 1 plus growth rate divided by the weighted average cost of capital minus growth rate. Next is to find the market value of common stock. That would be the market value of the firm subtracted to market value of debt and preferred stock. And lastly, to get intrinsic value of stock price, you need to divide the MV of equity to the number of shares outstanding.
Now let's have an example on problem 1 at Val Ceramic. Their free cash flow is 300 million, their growth rate is 4%, and their weighted average cost of capital is 6%. To follow the formula, it would be 300 million times 1 plus 4% divided by 10% minus 4%. That would be $5,200,000. Next is to get the market value of the common stock, and that would be the market value of the firm minus the market value of debt and preferred stock. And that would be 5,300,000 minus 3 million, and it will be equal to 2,200,000. And the last step is to get the intrinsic value of stock price. You need to divide the market value of the equity to the number of shares outstanding. And that would be 2,200,000 divided by 2 million shares, and it will be equal to $11. Therefore, the intrinsic value per share is equal to $11.
So let's start to another topic, preferred stock. Preferred stock is a hybrid. It is similar to a bond in some respect and to common stock. In the other term, stock refers to ownership or equity in firm. There are two types of equity, common stock and preferred stock. Preferred stock stockholders have a higher claim to dividends or asset distributions than common stockholders. The details of each preferred stock depends on the issue. The formula of the preferred stock: cost of preferred stock dividends divided by preferred stock price. Par value of one share of the preferred stock equals the amount upon which the dividends is calculated. In the other words, par value is the face value of one share of stock.